Hello everyone, this is Dad Rahman and welcome back to another video. Today is a recap on cash flows. It's a very important lesson, so you guys must listen. So cash flows. Now let's start off. What is cash flows? Cash flow is the flow of money inside the business. Let me get a better pen. Is the flow of money, cash flow is the flow of money inside the business. Now, there are two types of cash flows, guys. There is cash inflow, money coming into the business, and cash outflow, money coming out of the business. So cash inflow, capital, let's use the word capital coming into the business, and cash outflow, also known as expenditure, because that's the money that the business is spending on buying services needed to expand. So cash outflow, capital coming outside of the business. Well, capital going. Going outside of the business. So cash inflow and cash outflow. Now this is very important because in business there is a net cash flow financial statement, which is a big box. So cash inflow is known as your total receipts. So when you get a receipt, right, for example in a store, when you purchase something, that's money coming inside the business because you're spending your money, but the money you're spending is going inside the business. The business is gaining the profit. So that's why cash inflow is total receipt. And cash outflow is your total payment. When you pay for something, you're spending on it, aren't you? It's very obvious. Total payments. Total receipts and total payments. That's your cash outflow, that's your cash inflow. Now let me draw you this diagram. I'll fill it out for you guys. I hope you guys can see it clearly. Okay, let's draw this box. And draw some lines here. So this is your total total receipt. That's money coming into out of the business. So that's what I told you before. Sales March, April and May. Let me write it more clearly. Don't. Sales total is your payment. is your payment, your rates, your rate, rent and gas. Draw another heading here. So March your sales was £100, let's say. April was 120, May was 150. Total is going to be the same, 100, 120, 150. Here's your total payment. Payments, here's the heading. Total receipt, the heading. Rate, £80, £90, £100. Rent, 150, 160, 170. Your gas though, 200, 210, 220. Actually, I'll change it. Because remember, rent is a fixed cost, not a variable cost. 150, 150. So total payment, you add this and you add this. So your rates, rent and gas for each month. So 80 plus 150 is 230. So that's your 430. 430. 90 plus 150 is 240. 240 plus 210 is 450. And 100 plus 150 is 250. 470. So that's your total payment for that. Your total for that is going to be 200, 240 and 300. So now, what do you do now? There's something called, I'll write the formula here. There's something called the net cash flow. Net cash flow. There's a formula for this, and that is cash inflow. Take away cash outflow. Cash inflow, take away cash outflow. But if you get a sheet like this, it will say total receipt and total payment. Now this gets interesting. You will probably get confused by total receipt and total payment. What that means is your total receipt is your cash inflow. So replace cash inflow with total receipt. If you get that sort of balance sheet. And cash outflow, replace that with total payment. So your formula, instead of cash inflow, take away cash outflow, which is still the correct thing, it will be total receipts, take away total payments. So total receipt, take away total payments. That is another formula, and that's the correct formula. Now, I'll go up to here. There's something called the closing balance and the opening balance. I'm sorry guys, but I don't have enough space. But I'll explain to you what it is. So your opening balance, guys, is the amount of capital that a business has to spend at the start of the month. So your opening balance is at the start of the month, and it's for a set period of time. Start of the month, set period of time, set period. And your closing balance obviously is going to be the opposite of the opening balance. It's going to be how much money the business has spent towards the end of the month, and it's also for a set period of time. And also your closing balance starts the same at the next month. Say in March, right? For example, if your closing balance was £2,000, you'd start your opening balance in April with £2,000. Remember that. So, end of month. And also for a set period of time. Your opening balance with your closing balance. Now, I explained this. There's a formula for your closing balance. So closing balance equals opening balance plus net cash flow. Plus net cash flow. So your closing balance is your opening balance plus your net cash flow. So I hope you guys enjoyed this video. Thumbs up, like, subscribe, and hit the like button. Definitely, guys, hit the like button, please. And I hope you learned something. For now, I'll say goodbye, good night, and have a good night's sleep. Peace out. Peace out.